More than 2 years ago, Tunisian President Kais Saied publicly rejected what critics argued was a much-needed International Monetary Fund (IMF) loan to help the country deal with a severe multifaceted economic crisis rooted in long-standing structural imbalances, saying the funding would lead to more poverty. It stemmed from a fiscal model that had become unsustainable over the past decade. As of 2025, the country's public debt has passed the 80% of GDP mark, creating a precarious situation with high gross financing needs and rollover pressure. However, strong performance has been building momentum in agriculture, particularly olive oil and cereal production, is a key driver of growth in Tunisia. This year, agriculture contributes approximately 10% of Tunisia's GDP. In 2024, the North African country's agricultural exports reached $2.6 billion, an increase of 15.8% from 2023, which was a year of extreme drought.
A 2.5% growth rate in 2025 is a considerable increase from the 1.4% recorded in 2024. There is a gradual recovery and return to growth, but the Tunisian economy needs a much higher growth rate. The fact that economic growth depends on agricultural activity is not sustainable because this sector is highly dependent on rain, while the previous years were characterized by severe drought.
Economic observers say the lack of progress on structural reforms demanded by the International Monetary Fund is a major impediment to sustained growth. Tunisia has opted for internal financing as an alternative to a loan from the IMF. The government seeks new direct financing of $3.7 billion from the central bank in the 2026 budget.
Tunisia heavily relies on domestic financing from local banks and the central bank with a zero interest rate as an alternative to IMF funding. It's true that this approach eases the budget deficit. The country's economy is, however, heavily dependent on foreign funding. The state needs foreign exchange to import vital goods and products like cereals, fuel, energy, and gas from Algeria.
Financial analysts say the deadlock with the IMF leads to highly restrictive external financing conditions, which are expected to limit growth potential in Tunisia.
Today, the absence of an agreement with the International Monetary Fund, while Tunisia's sovereign credit rating is B-, does not favor investment. This situation makes it hard to access international financial markets. The cost of borrowing is too high for a fragile economy.
Tunisia's policy of self-reliance, as promoted by President Kais Saied, involves achieving economic independence and sovereignty, particularly by resisting external financing dictates from institutions like the IMF. Critics point to a significant increase in bank loans to the state, crowding out financing for the private sector and raising concerns about financial stability. Tunisians have endured 2 years of mounting economic pain, made worse by the coronavirus pandemic. While short-term growth is expected in Tunisia, persistent challenges like restrictive financing conditions and the need for structural reforms may lead to a slowdown in 2026-2027. Abdel Shawishi, CGTN, Tunis.